Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement costs with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Today on the podcast, we have Jay Scott returning. This was recorded for the 2026 Virtual InvestSmart Summit a little bit ago. This was one of 7 amazing sessions we had covering the economy, building an investment thesis, tax strategies, longevity, and other alternative investment strategies. You can buy the recordings and hear from the 9 expert speakers at investsmartsummit.com. It will be your best investment this year. Jay shares his insights on the Federal Reserve, inflation, AI, and opportunities in today's market. All right. Well, it is time. Welcome back, everyone. We have my good friend, Jay Scott, with a fireside chat where we'll talk about the Fed, interest rates, and the market impact. I've known Jay for a long time and always love his insights. Jay is an entrepreneur, investor, advisor, author, and partner at Bar Down Investments. Jay holds strategic advisor roles in several companies and is the author of 5 Bigger Pockets books on real estate, and you can see them behind him. Jay, thanks for joining me.
Hey, Gary, thanks for having me. This is going to be fun.
Yeah. So big news this morning. The investigation into Jay Powell was dropped, which clears the way for Kevin Warsh to be the chair of the Fed. Now, certainly he has to, go through everything, but I'm curious where, he's been critical of prolonged easing policy and the idea of a Fed put. How do you think markets are going to react when assuming he gets to be the Fed chair?
Yeah, so it looks like he's going to get confirmed. And honestly, I think he's a good choice. It's interesting. So if you would have asked me a month ago, I would have said he's an absolutely fantastic choice. I know there are a lot of people that were concerned that Trump was going to put a loyalist in place, somebody who was just going to do his bidding and just try and bring down rates, even if it wasn't the right thing to be doing for the economy. I think Warsh is historically pretty apolitical. And he seems like he'd have no problem kind of following his conscience as opposed to necessarily doing what he's told to do. Historically, he has been pretty tight on monetary policy. He wants to reduce the Fed balance sheet, which is good. Basically, we need somebody in that role that is going to kind of take the reins and not just keep printing more money or putting more money on the Fed balance sheet. And at the same time, he does want to lower rates, but he wants to do it the right way. He wants to do it structurally. He doesn't want to just get the votes from the Fed FOMC committee and bring down the federal funds rate. He wants to bring down mortgage rates. He wants to bring down car loan rates. He wants to bring down all the rates, not just the Fed rate. And there are structural ways that he may be able to do that. Now, all that said, if anybody that's been listening to the confirmation hearings, probably not a lot of people. I'm kind of a geek that way, and so I have been listening to some. There have been a few things he said at the confirmation hearings that indicate that he may do some things that are a little bit wonky. He's a big believer, and we'll probably talk about this at some point, but he's a big believer that AI is going to be highly deflationary. And he is in favor of basically changing the way inflation data is calculated based on forward-looking sentiment, basically saying, hey, we think AI is coming down the road. It's going to be deflationary. Therefore, we can kind of ignore certain inflationary effects in the market today because we think AI is going to be deflationary. And if you were to implement what he specifically wants to implement today, basically redefining how we calculate inflation, what we'd see is that core PCE inflation, basically this data point that the Fed relies on for their decisions, would be 2.3% instead of 3%. So one of the things I'm a little concerned about is that they're going to redefine how we calculate inflation. It's going to make the inflation number look a lot better than what it currently looks like. And that could be done, that could be used for good or evil. It could be used to create better models, but it could also be used to hide sticky inflation that's actually impacting us as Americans. So overall, I think he's a good choice. Don't have a lot of concerns, but he has said a few things that I'll be keeping my eye on.
So when I hear that, I'm thinking then he's really going to drive down rates, and that's that's what Trump really wants.
Yeah. Well, he's going to try. I suspect
Right.
he's going to try. I think he honestly believes that rates should be lower, that we're likely to see less inflation over the next couple of years, specifically again due to AI. But one thing we have to remember, and we've seen this over the last couple of years, is that the Fed doesn't control rates except the ultra short-term rate. So the Fed meets 8 times a year and they vote whether to cut what's called the federal funds rate, which is this overnight rate, the rate at which banks lend to each other. And over the last year and a half, over the last 18 months, the Fed has lowered that rate 1.75%. But if you look at things like mortgage rates over the last year and a half, mortgage rates haven't budged. Mortgage rates are exactly where they were a year and a half ago when the Fed started to lower their interest rate. So what that shows us, and what we've known but has now been well illustrated, is that the Fed lowering their rate doesn't necessarily bring down mortgage rates. It doesn't necessarily bring down car loan rates or credit card rates or business loan rates. Those things are controlled by the market. And so I think Warsh, he does want to bring down rates, but I think he's not necessarily in a position where he can just say rates are going to be lower. He can do some things to affect that, but at the end of the day, the market needs to agree.
Yeah, we're for our loan that we haven't locked in yet that we're closing on next week. I mean, it's risen quite a bit in the last couple of weeks, and there are these dips, and it just every other day up and down, up and down, and up and down. It's insane, and right, just because the Fed lowers their rate doesn't mean it's when you're buying properties and stuff that you're you know getting the benefit of that.
Yeah, it's really important to understand that the key driver of interest rates, especially mortgage rates, is inflation expectations. If investors believe that there's going to be higher than average inflation over the next couple of years, then it's likely that interest rates are going to go up. If they believe that there's going to be lower than average inflation over the next couple of years, then interest rates are likely to go down. And right now, we're in a position where investors are concerned about inflation. We've got high oil prices from the conflict in the Middle East. We're still dealing with some tariff fallout. We have generally messed up supply chains again from the Middle East. And we still have some sticky inflation from a couple years ago when inflation got to 8, 9, 10%. And so investors are worried about inflation. And again, when investors are worried about inflation, interest rates tend to go up. And there's really nothing the Fed can do about that.
So, how do you think that impacts the investor today? Like, what should they be concerned about? Where should they be focusing on given these data points?
Yeah. So if you look at the broader economy, what we're seeing is that things are softening. The economy is softening. Economic growth is slowing down. We saw significant slowdown in Q4. We're seeing slowdown in Q1. The labor markets are slowing down. We're seeing really high levels of layoffs. We're seeing high levels of bankruptcies and high levels of corporate insolvency. We're seeing higher levels of delinquencies in the credit card space. In real estate, we're seeing foreclosures. we're not talking about 2008 type levels. We're not talking about a massive recession at this point, but we're starting to see the signs of a softening. We're starting to see the signs of cracks in the foundation. And over the last couple of years, what we've seen is this very much what a lot of people refer to as a K-shaped recovery. Top 10% of Americans doing very well. Those who own assets, those who own real estate and stocks tend to be doing really well because hard assets are doing well. And they're the ones that are spending lots of money and keeping the economy going. Bottom 80 or 90% of Americans are struggling. And a lot of them would say they've been in a recession or they feel like we've been in a recession for years now. And so when we talk about the economy these days, we really have to differentiate. Are we talking about the top 10% who feel like things are moving along well? Or are we talking about the bottom 80 or 90%, those who don't feel like things are going well? And so overall, while you, me, a lot of people probably listening to this feel like things are pretty strong, there's a lot of Americans out there who don't. And when Americans feel like things are starting to soften, when they're concerned about the economy, when they're concerned about losing their job, they're concerned about their wages, they're concerned about getting their hours cut, what do they do differently? They spend less money. And when they spend less money, that actually slows down the economy. And so what I think we're heading towards, and it's exacerbated by the fact that we have this conflict in the Middle East, it's exacerbated by tariffs and higher prices from that, it's exacerbated by the inflation that we've had since 2022. It's exacerbated by a lot of things, but where we're likely headed is towards a recession. And in this country, we've had 36 recessions over the last 160 years. So recessions aren't uncommon, but it's been a long time since we've had one. And I think a lot of investors and a lot of Americans aren't accustomed to recessions. But I think we're going to have to get back into this idea of what's it like to live and invest in recessionary times. And so some of the things that we're likely to see. One, we're likely to see some tightening of lending. So not only are we likely headed towards a recession, but we've been in an expanding liquidity cycle. So basically more money flowing into the system, more money flowing to investors and Americans for the last 18 years, basically since just after 2008. Well, we're coming to the end of that natural liquidity cycle. So lending is tightening up, lenders are tightening up. If we head into a recession, lenders are going to tighten up even more. So it's going to be a lot harder for us as investors to get loans. So one of the things we need to think about is how are we going to finance deals moving forward? We need to really make sure our balance sheets look good, our credit scores look good, we have good income, our properties are doing well, because at the end of the day, I talked about this K-shaped recovery where some Americans are doing well and a lot aren't. It's going to be the same way with lending. There's going to be 10% of Americans who banks are going to be thrilled to lend to, and then there's going to be 80 or 90% of Americans who have a lot of trouble getting loans. And so what I recommend for investors is make sure you're in that top 10%. Make sure your balance sheet looks good, your personal financial statement looks good, your credit score looks good, you have access to cash, income, liquidity, all those things that as real estate investors we need to get loans. So that's number one. Number two, I do think we're heading towards continued inflation over the next couple of years. Real estate loves inflation. One of the best drivers of real estate values, especially in the single family space, is inflation. So even if we do head towards a recession, even if we do end up in a recession in the next 6 or 12 months, I don't necessarily think that's going to be bad for us as real estate investors. I think single family houses will likely hold up in value pretty well. Historically, we don't see single family values drop just because we have a recession. We did in 2008, we did in 1929, 1930 during the Great Depression. But the other 34 out of 36 recessions, we didn't see real estate take a big hit. So there's a really good possibility that even if we do enter a recession, it's still going to be a great time to be buying single family and residential real estate. On the multifamily space, I think it's likely that we, after several years of being in a really bad recession in the multifamily space, that we're finally at bottom and things are going to start getting better. I don't think it's going to be a quick recovery. I don't think that values are going to go up quickly, but I do think we're probably at the point where we're not going to see too much left in terms of values dropping, cap rates expanding. So I think there's opportunity for multifamily investors as well. And then on the commercial side, everything from self-storage to retail to warehouses, all look like they have some opportunities moving forward. Now, doesn't mean every asset class is great. Office is still struggling. Some retail is still struggling. There's going to be outliers, but for the most part, even if the economy is heading towards a recession, it looks like real estate's going to be a good place to be as an investor.
Yeah, I fully agree. And when we're talking about the lending environment, particularly for real estate, markets matter because when things sign up, tertiary markets are it's hard to get a loan for,
Yeah.
and also vintage now as well, where there some older products that lenders just don't want to loan on that. They're going to pick the very best ones, and so it becomes problematic if you don't have a deal that's newer enough and nice enough and in the right place as well.
Yeah, one thing to consider is that banks have been very forgiving for the last few years. Anybody in multifamily knows this. There's been a lot of distress in the multifamily market, but banks haven't been taking back properties. They learned back in 2008 that if you take back too many properties, it destroys your balance sheet. You end up with all these distressed properties that you can't get rid of. And so banks have been working with investors. They're basically saying, we'll work out your loans, we'll give you extensions on your terms. Banks have been very nice. I suspect, and we're starting to see that coming to an end. I think we're going to start to see banks taking back more properties, banks not negotiating as well and giving extensions as much as they have in the past. And as they start to get more aggressive on taking back these properties, they're going to have to be more tight or aggressive on, or less aggressive on the lending side. They can't afford to be giving lots of loans while at the same time they're taking back all these distressed properties. It adds too much risk to their balance sheet. So I think that's another thing that's going to impact a lot of lenders. And so one of the things you can do as an investor is, depending on who you're getting loans from, if you're getting loans from small, local, state, regional banks, it's not too hard to go out and do some research and find out what types of assets they have on their balance sheets. If they have a lot of office on their balance sheets, well, those banks might be in for a difficult time over the next couple of years. At the same time, large banks, the conventional lenders, then the quasi-government agency, the agency lenders, Fannie Mae, Freddie Mac, HUD, they're in pretty good shape from a balance sheet standpoint. And so I think a lot of what we're going to see moving forward is that we're going to have to be a lot more selective about the types of lenders we use, because there are going to be certain lenders that are going to be a lot more difficult to get good loans from. And then there are going to be other lenders that are a good bit easier.
Yeah, I could speak from experience. It runs a gamut. I have some lenders that are great to work with, some lenders that are really difficult to work with, and some that are right in the middle. And it really can affect the your deal if they're not working with you, if they're pulling all these different covenants from the agreement that you sign that you don't have that much say over. It can make life a little bit more difficult
Yeah,
than you want.
yeah, absolutely.
So I've got the $1 million question. I'm sure you get asked this a lot. And there's so many moving pieces right now. But where do you think the Fed rate is at the end of, let's say, 2026 and 2027?
As somebody who spends a lot of time following and thinking about the economy, I make a lot of predictions. And I will be honest and say I make a lot of bad predictions, or especially over the last couple of years, a lot of wrong predictions. It's been really easy to be wrong over the last few years. But I will give myself a little bit of a pat on the back. Back in 2022, I made a prediction that for the rest of the decade, so basically an 8-year stretch, that we would see two things. One, we would see single family housing values relatively flat, up a couple percent, down a couple percent, but relatively flat. And they have been down a couple percent, but since 2022, single family has been relatively flat. I think that's going to continue for the next 3, 4, 5 years. The other prediction I made was that interest rates, and this was back in 22 when interest rates were shooting up, and then we were getting ready to see them come down, and everybody was excited that we might get to low interest rates again. I made the prediction that I didn't think that was going to happen because of persistent inflation, and we talked about the fact that inflation expectations drive interest rates. I predicted that we would basically see 6 to 7% mortgage rates over the next, again, 8 years through the end of the decade. I've been right for the last 4 years. I don't think I see anything changing over the next couple of years. I'm not saying there aren't things that could change, but if I had to pull out a crystal ball, I would say we're in that 6 to 7% mortgage rates for the next few years. I wish I had better news, but I honestly think we're pretty stuck where we are for a couple of years.
And for single family, that's really, really tough. The mortgage payments have doubled for people
Yeah.
if you're buying a house now than years ago. For multifamily, it's actually pretty reasonable. You can get, agency debt sub five,
Yep.
to 6%, which is pretty reasonable, particularly with what we've seen is that cap rate expansion. You're getting some really nice cash flow now. So for us, it's kind of normalized, and sometimes people combine the two and it's two separate things completely.
Yeah, I think interest rates can be a double-edged sword for multifamily investors. It's good when you're buying because, again, inflation drives interest rates, and inflation is good for us as multifamily owners. Typically, inflation drives both rents and expenses, but it drives rents more than expenses. Basically, we collect more rent than we spend in expenses. So high inflation tends to increase our net operating income, which is very good. Higher interest rates and higher inflation tend to be bad for us if we want to sell our properties because higher interest rates, higher mortgage rates tend to lead to higher cap rates. And a cap rate is what ultimately determines the value of your property, a commercial property, when you sell it. And so these higher interest rates, these higher cap rates are going to bring values down. And so it really is a double-edged sword. I think higher interest rates are going to give us an opportunity to buy some good deals over the next couple of years. It may not be a good time to sell the deals that we previously purchased over the next couple of years.
Let's go. I wasn't expecting this question, but I'll ask it. How much and since when has England and the City of London controlled or influenced the Fed?
I'm not sure I can answer that question. I'm not sure.
Yeah.
I assume there's some backstory there that I'm probably not familiar with because I wasn't under the impression that England or London had control over the Fed, but maybe there's some conspiracy theory I'm not privy to.
All right. What are the most important data points you should be looking out for as an investor?
So at the end of the day, there are a couple of things that drive real estate. Number one, inflation is a big one. Inflation drives single family values almost directly. If you were to draw a line, or if you go online, you can find these graphs of inflation versus single family home prices. Basically, what you'll find is that for 116 years, from 1900 to around 2016, these two lines traveled almost exactly together. There was a blip around 2004 or 5 where home prices went up high. Then after 2008, they came crashing back down and those lines kind of coincided again. Since 2008, those lines have kind of diverged again and home prices are well above inflation. But for much of the last 125 years, what we've seen is that inflation and single family home prices are not only directly correlated, they're directly related, and that they move together. And so assuming that correlation continues to hold, and I believe it will. A lot of economists believe it will. I think higher than expected or higher than historical inflation that we're likely to see over the next few years is going to be really good for the single family market. There are definitely some headwinds in single family. High interest rates are not good for single family, obviously. Inflation from an expenses standpoint isn't necessarily good. Affordability is horrendous still. So there are a lot of headwinds with single family real estate. But the fact that we are likely to see higher than historic inflation is a great sign, and it probably means that single-family housing values are going to hold up again, even if we see a recession, even if we see some economic softening. So inflation is probably the biggest thing that I like to look at as a single-family investor. On the multifamily side, well, multifamily and any commercial are basically driven by two things. They're driven by the NOI, basically the income the property generates, and the cap rate. And so what I look for my commercial investments, for my multifamily investments, one, inflation, because again, inflation is what drives that NOI, that net operating income metric. And I look at interest rates because that's ultimately what's going to drive cap rates. Now, in addition to interest rates, we have things like risk. So, is there a lot of perceived risk in the market? If there is, that's going to drive cap rates up. Things like recession. So, recession in general. So, you can look at things like GDP, which is the economic growth, or the labor market, the unemployment rate, things like that. Again, those all impact risk. Those all impact the cap rates. And so when it comes to the commercial side of things, I'm looking at inflation, just like I look at on the single family side of things. And then I look at interest rates and general economic data to determine where cap rates are headed. So long story short, I don't look at too many esoteric data points. It's not something, and anybody that's listening to this can on any given day go look and see what's inflation at, what is unemployment at, and how is it trending, what is economic growth at, and how is it trending, and all of these things. And those are the things that ultimately are going to contribute to the real estate industry, whether it's single family or commercial.
And for an investor that wants to find this data, besides going through ChatGPT or Googling it, where's the best sources for them to find this data?
Yeah, so this is what I tell people that like want to start figuring out how the economy works and how all this data works. If you do a Google search for economic calendar and then Market Watch. So Market Watch is a company, a website, and they basically have a weekly economic calendar. So at the beginning of every week, they have for each day of the week, they list out these are the economic data releases that the government's going to put out that week, and private industries are going to put out. And so for next week, we're going to see a certain inflation metric come out. We're going to see economic growth for Q1 come out. We're going to see certain unemployment data come out. And you can see on a given day all the different data releases that are being released. And then you can click on the result of whatever that number is, whatever that data is, and it will take you to the government report that was actually released. And so what I recommend is everybody just get into a habit of once a day, generally after 8:30 a.m., because that's when most data is released. Go on to Market Watch, Economic Calendar, look at the data that was released that day, go read the government report that released that data. And if you have questions about what you're reading, if you don't understand what you're reading, cut and paste it into AI. It's great. There are days when I'll look at a long report and I understand these reports. I like reading these reports, but sometimes I just want an overview of what happened with economic growth in Q1 broken down by component. And I don't feel like reading through 30 pages to figure that out. I will literally cut and paste the report into AI and say, summarize this for me. And then you ask questions, and you do that for 3 months, and you'll basically hit every piece of government economic data that's released, because at most, these data releases are once a quarter. And so you do that every day for 3 months. 3 months from now, you will know every piece of government economic data that's released, and you'll also know where that data is sitting, how it's trending, and what it means.
So that's a challenge to you guys all listening. Do that, and we'll send out a quiz in 90 days and see how well you do.
Here's the other thing I'll tell people. I write an economics newsletter. Get on my newsletter, and I try and spend a good bit of time kind of breaking down what these data releases mean and what the data is telling us. And so I'm always happy to help with that as well.
Yeah, I definitely recommend. Well, put it in the chat where they can find out that information, Jay.
I will.
We touched a little bit on Warsh's viewpoint on AI being deflationary.
Yeah.
You know, what is your take on AI?
So I am a little bit contrarian, but my take on AI in general is that there's going to be two phases. So first, I know let me define a couple terms. So inflationary means it generally drives up the price of things. Things are inflationary when, let's say, you have to pay employees more money. So whoever's manufacturing stuff, if they have to pay people more, that's going to drive up the cost of that thing. If they have to buy raw materials or goods, overseas, and let's say they have to pay a tariff to buy those things. That's going to drive up prices. That's inflationary. Deflationary basically means prices are getting driven down. And a lot of people talk about the fact that AI is likely to be deflationary because we're going to be able to fire a lot or lay off or get rid of, however you nicely want to say it, a lot of people and replace them with AI. So instead of having to pay a middle manager $150,000 at Facebook, we can replace that person with a $5,000 worth of AI compute power or tokens. Instead of having to give them a cubicle in a building that they're paying another $3,000 a month for, well, we have a computer somewhere in a data center in the middle of nowhere that costs essentially nothing. And so by replacing people with AI, it brings labor costs down tremendously. And in theory, when your labor costs come down, the price of making products in general comes down. And when the product's price comes down, you can pass it on to consumers at a lower price and things get cheaper. And so the general theory is that over the next several years, AI is going to be highly deflationary. It's actually going to cause prices to come down. Now, I'll get to that, and I agree that that's going to happen. But a lot of people think that's going to happen next week, next month, next year. I actually think over the next couple years, AI is going to be just the opposite. It's going to be inflationary. So one way to think about this is last year, big AI companies, OpenAI, Anthropic, Grok, all these big AI companies spent about $600 billion on data centers and servers and all of this AI technology. At the same time, this year, those companies are going to generate about $200 billion in revenue by selling tokens, by selling AI functionality to consumers. So basically, they need 3 years of revenue to pay off what they spent last year to build all those data centers and buy all those servers. The problem is those servers aren't going to last 3 years. Those servers are going to last a year, year and a half, and then they're going to be replaced by better technology, better chips, more efficient technology. And so basically that $600 billion that was spent last year is never going to generate a profit. It's going to generate a loss. And at some point, the AI companies are going to decide we can't continue to operate at a loss. We need to generate a profit. So what are they going to do differently? Well, they're going to start charging a whole lot more for their compute power. They're going to start charging, OpenAI is going to start charging more than $20 a month for an OpenAI subscription, a ChatGPT subscription. Anthropic's going to charge more than $100 or $200 a month for a Claude subscription. In fact, we're likely to see the cost of these things go significantly higher in the short term so that these companies can cover their costs and continue to build out infrastructure so that they don't have to keep taking losses. And the extra costs that you're going to pay, I'm going to pay, big companies are going to pay to get access to this AI compute power is actually going to lead to higher prices, higher costs, especially in companies that have started laying people off. They've started laying people off, and now they're going to have to start paying exorbitantly higher rates, sometimes higher than having a person in the seat. And so what I think is likely going to happen over the next couple of years, while we're still working through the efficiencies of the hardware and the software as well, is that the cost of AI is actually going to continue to go up, and it's going to push the price of the manufacturing and the companies that are using AI higher. And so I think AI is likely to be inflationary over the next couple of years as opposed to deflationary, which goes against what a lot of people are thinking. I could be right, I could be wrong, but assuming that's the case, you add that to all the other inflationary pressures we're seeing. We're seeing tariffs, we're seeing the stuff in the Middle East, we're seeing oil, we're seeing supply chain constraints, we're seeing the inflation we saw from 2022. Add it to all that, and basically all you have is more inflation. So I think for the economy, that's not necessarily going to be good. For people, it's not necessarily going to be good. But again, for us as real estate investors, that might actually be pretty good. I think if you look a little bit further down the road, 3 years, 5 years, 7 years, what we see is that these AI companies have figured out how to scale the hardware. They've figured out how to scale the software. They've figured out how to scale the data centers. And we finally get to that great place where AI, and it's great from the technology side. It's not necessarily great from the human side. It's not necessarily great from an economic standpoint. But from the technology side, it's great. We can replace all of these millions of people with AI and technology. And that should bring down the price of goods and services, which should ultimately lead to people paying less for stuff. But here's the thing that's bad about deflation. When the price of stuff comes down, well, generally you have a lot of people that are out of work, so unemployment's going to spike. People aren't going to be paying as much, and so employers don't need to pay as high wages. They realize that they can pay lower wages. There's a lot more demand for jobs. You now have 30 million people all competing over a million jobs that are left, and companies can pay a whole lot less. So wages start to come down, the price of stuff comes down. Well, I talked about the fact that inflation is good for us as real estate investors because it drives up rents. Unfortunately, deflation does just the opposite. It drives down rents. When people are making less money, when things cost less, generally it's going to drive down rents, and that's going to drive down the values of our real estate. And so I do think over the next 5, 7, 10 years, AI is going to be deflationary and it's going to have a negative impact on real estate. It's probably the biggest risk to us as real estate investors ever.
And so, what do you think? How you talk about job loss, and we've seen, there's, when the iPhone came out and computers and all of these, there's always, even like you look at factories or and Amazon and how it's a very mostly robotics now and everything, but we always seem to create new jobs for people, and particularly as we have this so-called like silver tsunami.
Yep.
Like there's more and more people that will need to enter the health field to help
Yep.
people as we continue to be a sicker
Yep.
nation. So curious, if, what your thoughts on that?
Yep.
Because yes, there'll be contraction in some areas, but there should be expansion in other areas as well.
Absolutely. And I'm 100% confident that we're not going to just have, well, I shouldn't say 100%. I'm not 100% confident of anything. I'm fairly confident that we're not going to have 100 million people unemployed. I know that was a big concern back during the internet boom. A lot of people
Right.
thought, okay, well, we're going to have all this automation through the internet. We're not going to need as many people. Well, it turns out that there are all these new jobs that were created due to the internet, which replaced all the jobs that the internet took. It's people that were travel agents and worked at newspapers that were no longer in a job, now had plenty of other jobs to take thanks to the internet. So I'm not concerned so much that people are going to be unemployed. The big difference with AI is that unlike other sequences of automation that have been implemented in this country, you look at the Industrial Revolution, you look at the internet, you look at a couple of different things in between there. The jobs that were lost, the jobs that were replaced, tended to be lower and lower wage jobs. And they were replaced with higher end, higher wage jobs, the people that were actually implementing the technology, creating the technology, maintaining the technology. With AI, at least right now, and this could certainly change, but all indications are that AI is coming after the high paying jobs. It's coming after the white collar jobs, not the blue collar jobs. And so those white collar employees very well may, and I would guess they certainly will find other work. The question is, are they going to find other work at $100,000 a year or $200,000 a year, whatever that it's paying, or are they going to have to find work at $50,000, $60,000, $70,000 a year because those white collar jobs, those technology middle managers or technology even executives or engineers, software developers, are those jobs just not needed anymore? And the jobs that they're being replaced with are not the $200,000, $300,000, $400,000 a year jobs that Silicon Valley employees are typically accustomed to.
And so here we've got this fast moving train of tech and AI, and our educational system is the slowest moving turtle that's out there, not keeping up. And I'm seeing some programs that are really interesting for students right now, but not enough of that to really, because that has to evolve quickly too for people to be educated on new careers and new paths for success.
I'll be honest. I have two kids. I have two boys, ninth and 10th grade, super smart kids. I'll admit I've always had this bias. My parents didn't go to college, and they instilled in me that I had to go to college. There was no option. If you want to be successful, you have to go to college. And so I grew up with this idea that like you have to go to college to be successful. And this has always been a bias of mine, and I always assumed my kids would go to college, and it was never even a question until about a year or two ago. And my kids have finally gotten to that age where my 10th grader needs to make some decisions in the next year or two. My ninth grader needs to make some decisions in the next year or two. And I don't know what to tell them. I'm not sure that college is necessarily the right answer. And if they do go to college, I don't know if I would have any good recommendations on what they should, or obviously it's up to them. But if they were to ask my opinion, I mean, a year ago, I would have said, of course, if you want to be a software developer or an engineer or a lawyer or a doctor, why not? These are great fields that are so much needed. But the reality is, we don't know what the world's going to look like in 4 or 6 or 10 years. We may not have very many software developers. We may not have very many attorneys. We may not have as many doctors. A lot of these roles may be taken over by AI. And so for anybody that's in my spot where they have kids that are getting ready to go to college and kids that need to decide or want to decide what they're going to likely do for the next part of their lives, I don't know the answer.
I had one daughter that graduated Northeastern a year and a half ago. She started going to college during COVID, and I'm paying insane amounts of money for her to go to college, and she's not even like, experiencing it. And I'm like, before COVID even hit, I thought it was like I do believe in that experience of going away and being responsible and figuring out and all that stuff. But the cost is just insane, totally not worth it. And so when I was working in education before I got into real estate, we ran after school programs, outdoor ed, leadership development, and we would put kids on track for 2 years of community school,
Hmm.
um, which is super affordable, and then they would transfer and they get all the credits to go to these other nice universities, but they got a real good education at a much more affordable price. Is just a much more affordable way to go.
Yeah. And so, I mean, if my kids were to ask me today what they should do with respect to college, again, obviously it's their choice, but if they wanted my input, I would not be averse to a community college for a couple of years. I wouldn't be averse if they want to go to college, just get a general business or finance degree. I think those are pretty flexible, and if you can learn to think and you can learn to learn how to be an entrepreneur, hopefully you can help navigate what's likely to come yourself, or they can learn to navigate what's likely to come themselves.
Yeah. Yeah. If there's obviously a ton of noise out there, and if you had to simplify it for an investor, like what should investors focus on and what should they ignore right now?
Yeah. In general, it's always a good time to be buying real estate. So I don't ever see a bad time to buy real estate. If you look at any 10-year period in the history of this country, real estate only goes in one direction. So even though I'm saying I think we're in for some headwinds, we might be headed towards a recession. There's going to be inflation. There's likely going to be some other economic softening. It's not to say people shouldn't buy real estate. They should. But, and I will say this, and I know it's going to sound a little cliche, but it's time to get back to the fundamentals. So it's time for people to go back, and a lot of people who have just started investing in the last 10 years, they don't know what it means to go back to the fundamentals. It was nice for the last 10 or 15 years. It's hard to make a mistake in this business. If you do make mistakes, you probably make more money. If you buy a house and you want to flip it, and it takes you longer to renovate than you expected, you're probably making more money because the market's gone up if it's taking you longer. And if you've spent too much on your renovation, well, the market's gone up and you're making money, or you spent too much on your holding costs, the market's gone up and you've made money, and you underestimated your resale value, probably market's gone up enough that you still make money. We're past those days. And we're back to the days where you have to do things right if you want to make money. And the best way to do that is to be conservative. So if you're planning to do a 1 or 2 or 3 year project, well, maybe start to think about it as a 3 or 4 year or 5 year project, because a lot can change. Make sure you have a mitigation plan to extend any deals that you do, especially in the multifamily world. A lot of people in the multifamily world, we like to do these 2, 3, 5 year deals. Well, anybody that bought back in 2021 or 2022 knows that we're almost 5 years in, and a lot of us aren't close to being able to sell our properties. So hopefully we had those mitigation plans back when we purchased. If you're doing single family, make sure you have a secondary exit strategy. If your plan was to flip a house and you can't sell it on the back end, well, what's your backup plan? What's your plan B, your plan C, your plan D? Along with these longer time frames and having a mitigation plan to extend your deals, make sure you're getting longer term debt. So again, a lot of people, especially in the multifamily world, who got into trouble after 2021 and 2022, they got into trouble because they took short-term debt thinking that interest rates either wouldn't go up or they would go up and they would come down quickly enough that they wouldn't get caught. But what a lot of people have found is that what we thought was going to last a year or 2 or 3 could last a long time. We could have higher interest rates for a lot longer than we expect. So make sure you're factoring in longer term debt. Be realistic in your pro formas. Basically, instead of assuming we're going to get 3% growth in rents over the next couple of years, like we have historically gotten in a lot of markets, that might be 1%. It might be 2%. Likewise, instead of assuming we're going to pay 2 or 3% increases on our expenses every year like we have historically, well, with inflation, we might be paying 3% or 4%, or like we've seen with insurance and property taxes over the last couple of years, could be 5, 6, 7, 8%. So be realistic on your pro formas, your rental income, your expense growth, and don't jump into a deal just to jump into a deal. There are going to be a lot more bad deals out there than there are good deals. I know for a long time, again, much of the last 10 years, you could buy anything and you'd probably make money on it. It's not going to be that way. We're getting back to the 2008, 9, 10, 11, 12 era where 1 in 50, 1 in 100 deals are going to be good. They're out there and you can find them. But don't rush into a deal just because you feel obligated to do a deal. And if you look at 100 deals and you don't find a good one, you're not necessarily doing anything wrong. So be conservative. And the last thing I'll say is I think we have to go back to the age-old adage of you're making your money when you buy now. Again, we got into this time period where you didn't necessarily have to buy smart because the market would correct your mistakes. We're not there. You need to make your money when you buy. You need to buy at the right price. You need to be very conservative on your going in prices. And you're going to have to get good at negotiating. You're going to have to get good at making lots of offers and again, being patient. But if you do that, if you focus on fundamentals, if you focus on being conservative, if you focus on making money when you buy, if you focus on conservative pro formas, and if you have a backup plan for if plan A doesn't go right, or plan B doesn't go right, or plan C doesn't go right, there's no reason why you shouldn't be buying real estate right now. Because again, I said it before, I'll say it again. There's been no 10-year period in this country where real estate values haven't gone up. So in 10 years, no matter what happens between now and 10 years, as long as you don't lose your property, you're going to be glad you bought it.
Well, I mean, that's as good of a mic drop as I could have asked. Jay, thank you so much for sharing your wisdom. I always appreciate it. And you put in the chat, okay, where they can
Yeah. So
jscott.com. Okay, great. Perfect.
yeah. Anybody wants to reach out to me, my email's there, my newsletter's there. Anything you might want to find, jscott.com.
I hope you guys got as much value as I did. Jay provided a ton of great insights, as usual, for you to make more informed investing decisions. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.